The best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. After 12 months of price volatility, huge losses being made, and the unpredictable nature of the luxury watch market, I think that statement just about sums up exactly what it means to correctly invest in watches in a post-watch market crash landscape. The question I get asked every day: how do I go about building an investment portfolio of watches? Now, I've spoken about this before, but this last year really more than ever has brought into question the integrity of this whole idea of investing in watches for long-term gains. So, is it a load of bullshit now? Welcome back to the channel. Now, you'll know that I do believe that certain watches, if chosen carefully, can be considered investment grade assets. And of course, this channel is called Watch Investor Vinny, so let's talk about investing in watches 1 year on from the market crash. Now, what I'm going to do is I'm going to go through 7 rules that I believe you should apply when investing or choosing watches to invest in for long-term gains. So let's get into it. Rule number 1. Ignore this whole idea that anniversary watches are automatically good investments. Now, obviously, there are lots of Rolex pieces in particular that are anniversary pieces. If we look at the John Mayer Daytona, we know that that watch went up considerably. That one has been less of a certain steady grower in investment terms, which is what an investor wants. A watch like the John Mayer Daytona has been more akin to a yo-yo. It's all over the place, up and down in terms of values on the secondary market. We know that that particular anniversary green dial John Mayer Daytona was all the way up to £90,000 at one point a year ago. Then it tumbled after the market crash down to 50, 60,000. Then of course it was discontinued a month ago and it went back up to 75, 80,000, a 20% rise from where it was before. And now it's fallen by another 10%. The other thing that you've got to question with a lot of these anniversary watches that Rolex put out particularly is how long has it actually been in production for? With the John Mayer Daytona, it's been in production for 7 years. So it's not like there's a few of them out there. So there isn't real scarcity of this watch available on the secondary market. And therefore, yes, whilst it's special, yes, whilst it's an anniversary piece, it isn't really that rare. Rule number 2, gold is cold. Yes, guys, right now, solid gold pieces are not really in demand. I mean, that is across the board, not only with Rolex, Audemars, Piguet, Patek, Philippe. Those pieces that are over £30,000, of course, there is a much smaller pool of people that are interested in buying them on the secondary market, which means that there are fewer dealers actually interested in taking them off your hands, even if you buy them brand new walking out of the authorized dealer. There are a lot of pieces, even the Rolex solid gold root beer, that is now below retail in trade price. If you've watched our flip or pass videos, that is now a pass. Gold pieces have not moved or risen in price for nearly 2 years. Now, I had somebody message me only the other day saying, Vinny, look, I've got this Rolex root beer that I just spoke about there. I paid £38,000 for it and I'm really bored now of sitting on this piece. I've sat on it for 2 years. I've not worn it. I've stored it away in the safe. I know I'm going to be making a loss on it. And he bought that really before the major hype that surrounded the watch. Gold is cold, and the real reason it's cold is because if you've got £35,000 to spend on that solid gold root beer, that really is 2 or 3 stainless steel pieces that you could have bought, or even with vintage pieces, you might have been able to buy 5 or 6 of them. And I know in the last year, vintage pieces haven't really been affected by the so-called watch market crash or correction. So you could have actually made more money on 10 Omega Seamaster 300Ms from the 1990s than a solid gold root beer sitting in your safe. So there's also this other factor of diversification. If you take that £60,000 and you spread it across other brands, other stainless steel pieces, you have more pieces, more than just 2 at a lower price point, which of course stainless steel is. You tick this box of diversification and actually minimize the risk or exposure to a volatile market. And that leads me of course on to rule number 3, which is diversification, diversification, diversification. This is absolutely crucial. As I've said, it is the old rule in investing that do not keep all of your eggs in one basket. Because if you do, if one of them falls in value, they're all going to fall in value because they're all the same thing. And when I talk about diversification, what I also refer to is don't just consider investing in the same material, we've spoke about that, the same model, and even the same brand. In most cases, Rolex will form the majority of your investment portfolio. That just makes sense. It is the king of the watch industry. It is the brand that most people want, and I'm sure the collectors of the future, which are your target market. You've got to think about that when building your portfolio. I had another client who approached me a couple of months ago and said, yes, I've got a solid gold John Mayer Daytona, I have an olive dial day date, which, you know, all of the usual suspects, and a solid gold Rolex Submariner Bluesy. 3 superb watches, but he was concerned that in the last year they've done nothing but fall in value. He asked me, well, how can I change this up? How can I make this so that it actually makes money for me? Now, if he had a few vintage Datejust, for example, a 16200, then actually they wouldn't have lost any value at all. In some cases, they'll have actually gone up in value in the last 2 years. So those gains that those Datejusts in your portfolio would have been making actually would negate the losses that you would have made to some degree on those gold pieces. So you would have had a balanced portfolio and not really felt too much pain. Rule number 4, do your due diligence. Like with all investments, look at the long-term bigger picture, the long-term performance of that watch on the secondary market, not just recent history. For vintage pieces like the Datejust 16200, there's a lot of history to these watches. There is a lot of data out there and historical data to analyze how much that's grown over the long term. So whilst you may see for some models a volatility in the last 2 years, you've got to really consider it as an anomaly and look at the bigger picture. Look at that line of best fit, as we used to learn about in secondary school. You know, you've got the price of that date just going up slightly over time, gradually, steadily. Then in 2021, we saw the boom in the watch market. 2022, we saw the fall. Well, really those 2 points you've got to discount, and you've got to look at that line of best fit that should, in theory, continue to steadily rise. The data's there on websites like Chrono24, on Watch Analytics. Them are 2 fantastic websites for that kind of data. Not completely accurate in terms of the actual prices, but they are accurate in terms of trends. So that due diligence is important. Rushing into making an investment, buying a watch to put away as an investment piece, is the worst thing you can do. And that brings me smoothly on to rule number 5. Choose watches with scarcity and uniqueness that will appeal to a mass audience, not watches with scarcity and Marmite designs. Now, what do I mean by this? The particular watch itself, you've got to look at pieces like the Rolex Explorer 2, the 1655. This is a highly collectible watch and has been for quite a few years now. And I'm sure in the future, obviously it's going to become more scarcely available on the secondary market, and it is incredibly unique and tasteful. It does appeal to a mass audience now, and it will appeal to a mass audience in 10-15 years time. However, if you chose a Rolex Cellini with a mother of pearl dial, for example, yes, that's got great scarcity, but it isn't particularly a design that anybody would want. So you have to really put yourselves once again in the shoes of that future collector. Why does the collector want that piece in the future? They want it because it appeals to them. It appeals to their taste. And to do that, to work that out, you've really got to pick watches that appeal to mass audiences, mass taste. Rule number 6 of investing in watches in a post-watch market crash landscape. Choose what is right, not what is necessarily the cheapest. It doesn't matter if you spend a couple of £100 or even £1,000 more buying a Rolex Submariner Hulk, for example, the 116 610 LV. in very good condition. Spend a little bit more to buy one that hasn't been polished, to buy one that comes with a full set, to buy one that has a service history but hasn't been over polished. You know, that's difficult. That's a journey that you've got to go on. But I really do believe that in the long term, for long-term buy and hold watch investment assets, you have to choose watches that are complete. If a watch has been discontinued and you have a choice of which age that you can buy, go for one of the last editions. So with the Submariner Hulk, it will cost you a couple of £1,000 more for a 2018 than a 2014-15. But it is well worth it if it's a long-term investment, because that is what the collector of the future will want. And the final rule, number 7, basically underpins all of the first 6 rules that I've spoken about, and that is what I like to call the keep it boring principle, and leave emotion out of that purchasing decision. Buying investment pieces, you're buying them to put them away. You're buying them in the hope that in 5-10 years they will have appreciated in value. So you have to really ignore all of the noise that's going on around you, lock yourself in a room, do your research and judge this objectively, not subjectively. You've got to make those purchasing decisions for that investment piece based on facts. That is how Warren Buffett chose his stocks and shares. He didn't buy Coca-Cola, for example, because he likes drinking Coke. No, there was no emotion in that purchase decision. That decision was made because objectively, it was the right one to do. It's even more difficult with watches to leave emotion out of that purchasing decision. You can't be buying pieces because you like them. You can't allow that emotion, that niggling little voice to enter your mind and saying, yeah, I really like that watch actually. I really like the olive dial day date because my mates have got one and I want one myself and I've tried it on. And yeah, it will be a good investment. So you end up convincing yourself, you end up telling yourself, because that's what Instagram's telling you, that's what your mates are telling you. Investment shouldn't be emotional, it should be objective. So do your due diligence, put the hard work in, lock yourself in a room, ignore the noise, ignore the trends, and I'm sure 5 or 10 years time you'll thank yourself for leaving emotion out of it. Anyway guys, I hope you enjoyed this one. Do join me next week when I'm actually going to run through and scenario test some portfolios of watches that clients have asked my opinion about, watches in a portfolio that they built a year or two ago. How have they performed? Please do check out beatthewaitlist-watches.com, and I'll see you next week. Take care.